I look at the question of that it is unusual to have any federal backstop unless we have a public interest or a breakdown in the private market where a government role is needed to restore functionality. And in the case of terrorism risk insurance, I think, in my view, we have both. If terrorists attack the country, the United States has a national interest in minimizing the economic harm they inflict. And in terms of market functionality, unless private actors, which seem to me are inherently limited in the things they can do to evaluate and reduce their risks, for example, should insurance companies start their own intelligence agencies to improve their predictive models, or commercial real estate owners conduct counterterrorism operations to lower their premiums? Now, that may be a bit extreme, but the point is that there are certain elements to make determination of risk in the marketplace that are particularly difficult when it comes to the potential act of terrorism. So one, just for the record, if whoever wishes to answer it, what makes terrorism different from other risks that therefore should elicit a federal backstop? Mr. Elliott.
Senator, let me start. I would say at the core of that question is the fact that terrorism is an intentional act. And that's different than anything else we underwrite or insure or price as an industry and as a company. And that makes this incredibly challenging.
Mm-hmm. I'd say a couple of other things, Senator. One is, fortunately, we don't have a long history to know how many events. So when you think about models, you try to look at the frequency of events as well as the severity. And I think the wide range of possibilities of what destruction can be makes models just blow up in terms of possibilities for that. The other thing that, and it's sort of back to what Mr. Elliott said about intentional, one of the things when I think about hurricanes or things like that, and there's risk mitigation techniques you can do in terms of building codes and all sorts of things like that that try to minimize the damage. The terrorists, I think, are constantly trying to figure out how to get around the risk mitigation techniques that are used by the government or by business and so forth. So there's a uniqueness to that we have a man-made event where somebody is trying to constantly reinvent how to create a particular attack, which is different than what we've seen in natural catastrophes and so forth.
Mm-hmm. Is there Henry?
In my mind, it's similar to a war risk. The industry has no control over that and the severity. Keep in mind, I think some people think that the industry has unlimited capital, but fact is the insurance industry in the United States probably has $600 billion in capital. It would be easy to see a $100 billion loss and maybe even a $1 trillion loss if it were a direct hit on New York City. Keep in mind the World Trade Center was a very specific target, and today's dollars, we're looking at $42 billion on that. Thanks, sir.
In another context of this, what would be the consequences of letting TRIA expire for communities in this country that build or operate critical infrastructure such as rail lines, power plants, highways, airports, pipelines? If these investments become more costly, doesn't that have a nationally adverse impact? If you look at the region that Senator Schumer and I are privileged to share, we have a 2-mile stretch that contains the largest container port, the megaport of the East Coast, one of the busiest set of airports in the country, rail lines that carry hundreds of thousands of people back and forth to work every day, critical industrial infrastructure, not to mention high population densities. But that's not unique to us. There are other regions in the country that emulate that in their own way. What would be the consequences of having no federal backstop in terms of insurance to regions in our country that are drivers in a great part of our economy? Mr. Wells.
Senator, I think the most natural result from that, especially if it's in the public sector, is probably what happens is that there will be no insurance to deal with those problems when they occur. And so either the state or the federal government will end up being the insurer. Because the private sector does not have the capacity to step in without a TRIA backstop. And consequently, that means that it won't be there for those different sorts of infrastructure situations. And so when the problem occurs, the federal government or the state government will really become the insurer.
And in the absence, final question, in the absence of insurance, then doesn't any future infrastructure development of that size and magnitude become far more costly, and as such become a question as to whether or not it gets built, which then becomes a question of economic opportunity for the future? Is that a fair statement? Does anybody disagree with it?
And who's going to write the insurance on the workers that are doing that rebuilding?
Thank you, Mr. Chairman.